Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Trading Room, live streaming in YouTube. Well, as we come into this morning here, are you wondering why is the price of gold down? I am. Under the tremendous bullish news, fundamentally, of stimulus and short squeeze and short supplies. We'll take a look at the market here in terms of the artificial intelligence for gold, silver, and the mini S&P as we come back, and we'll take a look and see what Niki the robot is sharing for us for the weekly reports. We'll be right back. Welcome back, everybody, and I hope it's a good start for this week. The gold market is in a bit of a draft, you might say, but with a major reversion unfolding here from the buy two level, basically the buy two level and the buy one levels that were anticipated as we come into today's trading session. 1818 is the daily average price. 1827 is the sell one level. 1841 is the sell two level. Now we've come down very close to 1795 early this morning, and we are activating buy triggers basically as we take a look at the daily numbers. And I want to take a look in a minute here about the weekly numbers as well. So let me move right into what I would like to do here is share with you the weekly reports that basically were produced over the weekend here. So let's take a look at the silver, starting with the silver market, the weekly report as produced by Niki the robot.
Hi everyone, this is Equity Management Academy with the weekly silver report for July 16, 2021. Summary. The weekly trend momentum of 26.93 is bearish. The weekly VCPMI of 25.97 is bearish price momentum. A close above 25.97 stop negates this bearishness neutral. If short, take profits 25.37 to 25.05. Trading instructions. Weekly trend momentum 26.93 bearish. The silver futures contract closed at 25.80. The market closed below the 9 SMA. 26.93 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bullish short-term trend to neutral. Weekly price momentum 25.97 bearish. With the market closing below the VC weekly price momentum indicator of 25.97, it confirms that the price momentum is bearish. A close above the VC weekly, it would trigger weekly stops and negate the bearish signal to neutral. Weekly price indicator. Exit. Longs, sell 1, 26.30. Sell 2, 26.91. Exit. Shorts, buy 1, 25.37. Buy 2, 25.04. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 25.37 to 25.04, and go long on a weekly reversal stop. If long, use the 25.04 level as a stop close only in good till cancelled order. Look to take profits on longs as we reach the 26.30 to 26.91 levels during the week.
I want to take a look at the report because I wanted to see what the market has done in relation to those numbers here. And as we take a look, the market has come down to pretty close to the buy 2 level of the 2505. And it's trading around the buy 1 level here of 2537, 2538. So we've activated a buy trigger in silver from the buy 2 level. And we're activating, after completion of the target from the level below, another buy signal by closing above 2538. The target is 2596 if activated. Let's take a look and listen to the gold weekly report. And we can take a look at the gold market as well.
Do you want to analyze commodities and
Hello everyone, this is Equity Management Academy with a weekly gold report for July 16, 2021. Summary: the weekly trend momentum of 1835 is bearish. The weekly VCPMI of 1813 is bullish price momentum. A close below 1813 stop negates this bullishness neutral. If short, take profits 1791 to 1767. If long, take profits 1835 to 1857. Trading instructions. Weekly trend momentum, 1835, bearish. The gold futures contract closed at 1815. The market closing below the 9-day SMA 1837 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Weekly price momentum, 1813, bullish. With the market closing above the VC weekly price momentum indicator at 1813, is confirmation that the price momentum is bullish. A close below the VC weekly, it would trigger weekly stops and negate the bullish trend to neutral. Weekly price indicator. Exit. Longs, sell 1, 1835. Sell 2, 1857. Exit. Shorts, buy 1, 1791. Buy 2, 1767. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1791 to 1767 and go long on a weekly reversal stop. If long, use the 1767 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1835 to 1857 during the week.
Let's take a look at the gold market here. And so far, we've come down pretty close to that buy 2 level of 1795. Activating 1795 with a low of 1795. And the market reverted right away from that level as Niki the robot was pretty accurate about this. The AI told us, do not sell into this level even though we may get a correction and a test, you might say, of the 1795. Now, this is basically a good example that if you are getting into the position long and you are entering multiple contracts, that you do not go short here between the buy one and buy two level, but you use this area to add to your multiple positions all the way down to 1795. And if you want your protective stop always, you can use that 1795 and a close below to stop you out. What you see here, right below the buy two level daily, is the buy one weekly level of 1795. 91, excuse me, 1791. So the market came down basically to 1795 and found buyers at the B2 daily level. And from there, it reverted right back up into the buy one 1804 and completed the target, the weekly target of 1813, and it's on the way to 1818. Now, what I want to say to you, ladies and gentlemen, if you're following me, or if you've been following my podcasts, my videos, I've been saying that the market in gold and silver has been acting completely the opposite of the fundamentals. And a lot of money has been lost on the long side, listening to a lot of these gurus that are anticipating astronomical numbers in the gold market, which may at some point, in fact, become true if some of these fundamentals continue to deteriorate the way they are, particularly as it pertains to the US dollar. I'm focusing right now on what the market is doing and what the market is saying, and applying the variable change in price momentum indicator, which is a completely mathematical system that is not 100% right. Don't get me wrong. Nothing is 100% right, except death and taxes, as they say. But when you apply technically the VCPMI into an emotional market like the one that we have right now, where things are completely the opposite, you can more or less identify the extreme levels of that basically structure in price, where the supply and demand reaches the extremes, and we get the reversion back to the mean. And that's pretty much the essence of what we do, is mean reversion trading. What I'm teaching you here, and I'm teaching my traders, my subscribers in my live trading room, basically how to execute this AI, which was written in C++. You heard Niki a little while ago. That is the C++ code. The application is yours. It's in your control, which is what I've done, is reverse engineered the intelligence that is of high probability mathematically of success for you as a self-directed trader to be able to navigate these markets, particularly when they don't make any sense fundamentally, or the market is trading the opposite of the fundamentals. So one of the things that we are dealing with right now, obviously, is the fact that we've had record levels here in the CPI, the PPI. Inflation is running at 5.3%. Much, much higher above, I think, anybody's expectations. And if you include food and energy, you're looking at maybe 8%, 9%. And so we are running into some kind of inflationary pressure. But according to some of the statistics that came out, and I want to share that with you, because I want to take a look at potentially what is happening here from a fundamental point of view. I would like for you to listen to Bond King, which is Stephen Van Matre, that is probably one of the best analysts that I have seen, and I want to share some of the information that he has, and we can make sense of it.
Without stimulus, are Americans about to go broke? Are we on the eve of a looming restaurant crisis? And as extended unemployment benefits are soon to expire, is the U.S. economy going to head off a cliff? Answer those questions and more on today's Macro Show. I'm your host, Steve Van Meter, and the survey results are in, or at least the preliminary ones, from the University of Michigan, saying that consumers cannot afford higher prices. They are screaming and saying this is it, no more. And when Americans stop spending, the U.S. economy goes with it. Because you have to remember, the American consumer is 70% of the economy. So when they've said they've had enough, watch out below. Let's take a look at that survey data because it's staggering. You want to talk about going from one extreme to the next, the pandemic? Well, the pendulum's about to swing all the way back again. Let's start here with the consumer spending intentions. So this is a good proxy when consumers are surveyed and they say they're eager to spend. Well, that's how they end up in a spending intentions report. And here's what the University of Michigan had to say. The spending intentions are crashing. And we're talking about 6 months ahead. Homes, appliances, automobiles. Well, okay, we know we can't buy automobiles because there aren't any on the lots anymore. But nevertheless, consumers are saying when it comes to home buying, appliances, automobiles, no plans to buy hardly at all in the next 6 months. It gets worse. Here is major appliance buying intentions. Just splitting this out, looking at the monthly change, huge crash. You have to go back to 2018 to find out when buying intentions for major appliances were this bad. And that's terrible. It's just kind of an indication that consumers already spent their stimulus checks on major goods and services, and now they're saying prices are too high. I don't need those things because I already bought them. How about homes? Remember, the real estate market's been on fire. Everyone's talking about how it's never, ever going to end. And yet here we see again, home buying intentions, monthly change, largest drop since 2000. Largest drop since 2000, telling you that there is nobody that wants to buy a home. Now, I'm sure there's a few people out there that do, but overall home buying intentions, massive crash. Telling you, consumers do not want to buy houses. How about home buyer sentiment? Well, you would expect that should follow suit. There it is. Home buyer sentiment absolutely continue to tank. I mean, it is terrible. The demand from buyers is rapidly expiring. If you've got a home for sale, I hope you can get it sold soon, because if this data is true, it tells you there's going to be a lot of for sale signs and no buyers. And meanwhile, home builders are being told that there's a massive shortage. So what are they doing? They're building more and more homes, while home buyers say, no, sir, not going to buy at that price. Moving on to the consumer sentiment index. And then we'll look at the economic conditions. That would be current conditions, and then expectations, which are forward conditions. You can see they all dropped. And again, this is just a preliminary data for July. We're not even at the end of the month. So if this trend continues, well, it's even getting worse. And the stock market has a relatively strong relationship with the University of Michigan Consumer Sentiment Index. In fact, the stock market's saying that consumers are going to be so euphoric, they're going to be up here, but sentiment didn't even get back to the pre-pandemic highs and is heading lower, suggesting stock prices are also going to follow the consumer down. And again, this makes sense if the consumer is 70% of the economy and they're saying, I don't want to pay these high prices. Well, you start to wonder, when I say that higher prices aren't necessarily inflationary, because you need an expansion of the money supply to justify it. So when are higher prices deflationary? Well, when you see survey data like this, it's saying consumers are going to reject them. And that's something that's very important to understand, because what this is telling you is financial conditions are tight and are tightening. It's also suggesting, and I know this is going to shock you, that monetary policy is too tight, that the Fed isn't doing enough, that rates are indeed not low enough. Can you imagine? They're not low enough, suggesting rates need to go lower to further ease financial conditions, but that's what this data is telling us. Let's continue on. How about inflation expectations? Now, don't read into this at all if you're bullish on the bond market like I am, because the consumer never gets inflation right. So consumers are worried about inflation, and so not only they're saying the prices are going higher, they can't afford them. So this is a big indication that inflation is likely to be transitory, because in order to justify higher prices, consumers, as I just mentioned, need to have the money to be able to afford them. So if consumers are saying, look, we don't want to buy now, we don't want to buy in the next 6 months, and we think prices are only going higher, what does that tell you for future spending? It's going to collapse. Let's continue on with this story. How about references to prices for homes, vehicles, and durable goods? Now, this is interesting because this data goes back all the way to the 1960s. And what is taken is the average, the percentage of the low minus the percentage of high. And so what this is telling you is the percentage of people complaining about prices being too high, we'll just say all-time record high number of people saying that no, prices are not good. They're not a place I can afford it. They are too high, and that means price rejection. That is how you get deflation or disinflation from higher consumer prices. I know it's not the mainline view of thinking, but here you can see in the data, it's very clear that consumers are saying prices are too high. How about bad buying conditions? Now, this is staggering. We're data back to 2000, and bad buying condition for houses. Look how, we're talking record high. How about bad buying conditions for durable goods in blue? Well, that's at a record high. And how about bad buying conditions for vehicles? Also record high, but again, as we know, there are not a lot of vehicles on the lot for people to buy anyways, so it could be bad because prices are high. It could be bad because, well, you can't get what you want. But what this is telling you is consumers are saying prices are high, and when consumers say prices are high, too high, they don't spend. Now, let's see if there's any data to validate this view, and this is a great piece from Bank of America, because one thing that I would have guessed is that the states, as their extended unemployment benefits fall off, would see a larger decline in spending against states that haven't. And I think someone at Bank of America must have thought the same thing, because they actually did a chart of that, showing the states with a June 12, 19, 26 expiration against the states that have no expiration other than the September 6 one that is coming pretty soon. And they noted little discernible impact of the expired benefits on an aggregated spending basis. Now, this is interesting because you could see the spending kind of surged up here into the July 4th weekend. And when we look at the retail sales, we're going to see this right here, this late June spending was probably what caught into the report, and that put up a month over. Bank of America is right, and they've been rather accurate, except for their call on retail sales this month. Then there is a cliff coming, and it has nothing to do with the extended unemployment benefits, which I find rather fascinating, suggesting that, again, all this data from the University of Michigan and their preliminary consumer confidence survey is spot on. Now, how about restaurants? Are we on the edge?
Are you saving for retirement or just treading water? Are you depending solely on stocks or mutuals instead of diversifying what you really need?
Of a major restaurant crisis? Well, I didn't really think we were until I saw this article. Check this out. I think you'll be surprised as I was. Look at this. The SBA, the Small Business Association, ends COVID lifeline with struggling restaurants still digging out. Well, no surprise. There are restaurants that are struggling. It would make sense. Now, I didn't even know there was a restaurant revitalization fund. Now, if you own one, you probably already knew this, but I had never heard of this until the other day. So the RRF, a critical post-COVID-19 lifeline, I just assumed that everyone was getting it from the PPP loans, and I didn't realize there was a special restaurant one, which is really cool. To help struggling eateries is now officially depleted. The Small Business Administration receives 370,000 applications from the food service businesses around the country for RRF money, and as of June 30th, the program has distributed $29 billion to more than 101,000 restaurants. That is phenomenal. That is excellent. However, the online portal has served as an application hub for the program will close on Wednesday, leaving 177 businesses without funding they need to keep their business afloat. And if you've ever owned a restaurant, and if you haven't, if you've ever been to a restaurant, they usually have more than just a couple of employees. So this will be really painful to start seeing restaurants fail at a time when not only states are getting rid of extended unemployment benefits, they're set to go away here in just about 7 weeks. In fact, here we see the owner of Dirt Candy in New York City said, we're still struggling to dig out from the pool from last year, so that's a problem. But there is some perhaps hope that there's something that may happen. And let's see down here, where is it? Here, last month, Congress introduced new legislation to refill the SBA's revitalization fund with an additional $60 billion, which I'm sure would be phenomenal for all the restaurateurs who are struggling right now. The effort dovetailed with growing calls for Congress to help small businesses rebound from the pandemic. But as of now, they have not done anything. So that is the key. Congress needs to act. And if they don't, well,
I think the idea, I hope you get the idea, basically, that things are not what they seem to be, and you can take a look at it yourself by going on and checking out yourself, basically, the data. But the thing that I've been looking at in terms of the gold market is that the gold market does not make any sense in terms of where it is right now in price in relation just to everything else that's going on in terms of monetary policy and stimulus and even inflation. To think that the gold market would come down on the face of inflation is, I think, a really unusual anomaly that we're looking at. And those anomalies are going to be corrected because again, the reality that I am looking at is that interest rates are going to come down as we move into the end of the year. We're going to begin to see a slowdown in the economy, a slowdown in what appears to be this runaway inflation, and interest rates need to come down further. Now, how does that affect the precious metals and all these assets that have been bombarded, basically? Right after Chairman Powell announced that they were talking potentially in tapering, which I believe was just a political measure, or I would say a rhetoric that verbally was able to take the edge off the inflationary markets. As you can see, we saw a massive collapse in precious metals and just about across the board on these instruments that were coming in here highly inflated, even virtual currencies. But I want to say this to you, that you got to prepare for the surprise of the year, that is essentially that rates are going to have to come down, and that is extremely bullish for all these assets that were hit, that went into a correction, that I believe will regain the value lost as a consequence of this just pure rhetoric and manipulation in the market. And we'll have to deal with the reality of the economic situation, and that is that the markets cannot withstand higher interest rates on the face of this crisis that we have, and basically on the face of this explosive debt that we have on a global basis. The economy globally is in a very, very accommodated state in terms of in terms of a stimulus. And again, central banks have agreed that they will do whatever it takes to control the markets without hopefully going into some kind of an implosion or deflationary cycle as we did back in March. So one thing to consider is that if we do go into some kind of a correction, where is the ammunition going to come from when we already are looking at about 10% of GDP? So we're at a very crucial point, and I think that the path of least resistance, once again, is basically for interest rates to come down. And the tapering talk is simply that, talk. The reality of the market is that it requires and it demands lower interest rates. Thank you again, everybody, and I look forward here to speaking with you again next time. Take care of yourself. Have a great trading day. Have a great